form of, it's not as, like money market where you want money, you can put in today, get it tomorrow. They have the 6 months and the 1 year period. They give the quarterly percentages. The first quarter they give 7, the second quarter they may be announcing anytime. So when they compound the 4 quarters, they give you the annual percentage. So for me, I have had clients who I have sat with. Mansa X is one of the companies I execute through my client. That's why I'm talking. Maybe I'm more confident to talk about them. And I've seen another client of mine with a JQuat lecturer. For the last 4 years, she grew the fund. Last year, she withdrew to upgrade a car and then started growing the fund again. So for me, it's a good place to diversify, especially if you have more than 250,000 Kenya shillings. And this is not all the money that you have in your account, because you have to lock it for 6 months and 1 year. If you have anything for emergency, open a money market. If anything, a rainy day comes, you go there, sort out your rent, whatever it is. But a special fund is a place where you lock in your money for medium term. Actually, it's short term because it's up to 1 year. But to enjoy the compound interest, you need actually to wait for quite a while. Last year, they gave 20.7, which was really good. So anyone with a million shilling made 200,000. Minimum after expense, after the charges. So for me, I would say special fund is a place to diversify, but also we qualify companies with how much time they have been in the market, what is the fund size, and what is their trend. So there are other special funds started from 2024. From where I'm sitting, for me, I would put in my money that I would not lose sleep by losing there. But when I want something that have been proven with time, I would put in Mansa X Special Fund.
All right, thank you. So Sam, could you speak around the ETFs and also just explain to those who don't know what the ETFs are, and also what their average returns are and how risky and stable it is?
Okay, so ETFs, I'll just start with the definition first of all, stands for electronically traded funds. And I feel like this is one of those jargon languages that are there that people look at and run away from, especially when you hear, but it's a very simple concept. You take one stock, it has a certain risk profile to it. So it might be a risky stock, it might be, an average risk stock. But then if you take a lot of those stocks together and put them in a basket, so instead of let's say buying one mango, you buy 40 mangoes, you put them all in one basket, that becomes an ETF. So you invest in the basket, not in the stock. And what that does is that it's able to hedge you from a lot of the risks that are there. So if one of the stocks inside the ETFs crash, it doesn't necessarily affect your entire portfolio very much, because that's just one in maybe 40 or 50 other stocks. And the ETFs are so many and so diverse. There are ETFs that have 1,000 stocks inside them. So even if 20, 30, 40 stocks were to go down, you still get an average, because definitely from that pool, there are some stocks that are up. So we just do an average to see how it is. It's not that simple per se, because ETFs also, how you distribute the money within the stocks is different, because there are some ETFs that do equal distribution. So 40 stocks inside this basket, all of them get the same amount, the same percentage. There are others that have weighted distributions. So some stocks get more money than others. And so that's just some of the stuff that makes things look so complicated, but it's not. And ETFs are a really good thing. I usually say, generally when I'm giving advice, I am a software engineer, and I am very wary about giving advice. I think I should say this now. This is financial education that you should learn. Repeat with me, this is financial education. Sawa. But it's good to learn. So what we say is, when you have an ETF, the good thing about it is it's very good, especially if you're starting to get into these international markets. The risk profile, again, because there are so many, it can be, I'd say, moderate to high also. So if you get an ETF that is very diversified, which means they have stocks from all over the world and different industries, that ETF usually is very hedged. So it won't be very erratic as it performs. It will give you moderate returns. Let's say somewhere around 18% minimum for some of these ETFs. Yeah. But then you'll also find ETFs that are very specialized, like ETFs that deal specifically with chip companies or AI companies or something like that. These are very specialized, and you need to be someone who has done a lot of research into that particular area in order to invest there, because now those ones, they properly move. You can wake up one day, your account is negative 30 or something like that. But then again, they also move in the positive side. So you can wake up one day and over 6 months, your ETF has given you 100%. So I usually say it's moderate to risky. It depends on which ETFs you go into. But if someone is starting out, I'd really encourage going into a very diversified ETF. It gives you exposure to a lot of companies and then hedges you, make sure that you won't particularly go through a lot of ups and downs. And still, it's a very good, maybe stepping stone into investing in global markets. So yeah, that's what I say.
All right. And do we have such an option in the Kenyan market currently? Any bank that's offering an ETF?
Not sure about the Kenyan market. I do know there's an ETF in the Nairobi Stock Exchange. I will confirm the name, but I'm very sure there's an ETF that came in, and it's very diversified also. It might be a good option for someone who might not want to maybe incur forex charges for investing abroad or something like that. So I'm sure that is still there.
All right. And okay, is there any other? Henry, speaking about all these investment options, is there one do they have a standard taxation rate, or is there one that's favorable in terms of tax?
Yeah, thank you, Stacy. So every portfolio has its tax rates, and the common one that we know is that we have interest income that you get, and also you have dividends that you get. They are subject to withholding tax, depends whether you are a resident or an unresident. The major one being 15% in the residency status. Something to mention in what happens in the tax jurisdiction. The commissioner determines your income based on the place of earning or place of accruing the income. So if you're investing in, let's say if you're investing in Tesla, and you're receiving some dividends from it. So the commissioner will determine that income. Yes, it has been derived from an unresident individual, but it will be taxed under the resident individual rates because you are accruing them from the Kenyan jurisdiction. So that's very important to note, the place of accrual. And we have seen so many tax cases determined by the tribunal whereby a tax, or rather a management, control, and accrual principle was used. I'm sure, I don't know if you guys have heard of the Naivas case. Speaking this because it's in the public domain, where the Naivas International Limited, they have the Naivas Kenya Limited, and then there is Jiwawa or something family in Mauritius. So the Mauritius one, they sell their shares, or they sell a certain stake, 38%, and then the commissioner assesses a 1.7 billion or something and they appoint Naivas Kenya Limited as the tax representative. So the whole issue that was going around is on the residency. So the people who are controlling the Mauritius entity were directors who are sitting here in Kenya. So all this is to emphasize on the principle of accrual, of where you have accrued your income, and specifically if you're accruing it here in Kenya, you'll pay using the resident individual rates. To answer on all those portfolios, I have been interested in one, and this is not a final decision so that you can think of investing in it. There is one that is called real estate investment trusts. Anyone who has heard of the rates? You have heard of the rates? Yeah. Thinking about the rates, when you're investing in a rate, you have seen how the housing, or rather the infrastructure development in our jurisdiction, that is in Kenya, it's growing really rapidly. And so as a form of encouragement to invest, or rather to invest in the property, it's called the building of those infrastructure, the government came up with these rates that would encourage investors to invest in the real estate and grow there. So how it happens is that it is in form of a trust. So you form a trust, a trust is formed, investors pull their money, they pull their funds into that trust, and then that trust invests those money into the real estate. So they can invest it as an income rates, they can invest them as development rates. So if it's income rates, suppose we pool funds, the four of us, and we call it YP trust or something, and then we invest in a real estate, maybe for development like the Konza, or even for income generating, perhaps just an apartment in Kilimani where we have not built, but we have invested in that space. And the income that is derived from that, it is usually a tax exempt. So a trust is usually by law, Income Tax Act, think the first schedule, it exempts trust income. But now there is a withholding tax that is applicable when you're investing in the trust, and withholding tax is usually a final tax. So if we have invested in this trust, and at the end of the year we are given dividends, those dividends will not be taxed because they have already been taxed as a final tax at 15% when they have been issued to the trust. So the trust the income that is only taxed in a trust is usually the dividend income. So when they have received the dividend income and they want to distribute it to the members, they distribute, and there is a principle called qualifying dividends. So when they're issuing out the dividends, they issue them as qualifying dividends, and these ones, they have already been taxed at 15%. So I, as the beneficiary, I will not bear any more tax. I will not bear any more tax obligation to that, since it has been taxed at the trust level as a final tax. So from a tax obligation perspective, I find rates to be more tax. They are like tax incentives, or they are like more of tax free. So we don't have to have a lot of hassles, thinking about the tax obligations. But the normal ones that we know, the dividends being taxed at withholding tax of 15%. So I think I would go more of rates if I'm to mention on the less tax incentives.
All right. Then also speaking of risk as well, which of these investment options offer capital preservation? That to mean that you do not lose the initial amount of money that you invested. So I'm sure most of these ones there's a regulation even by the government to protect the investors from losing the initial amount of money, but some of them, it depends on how the market goes. So which ones of these offer capital preservation? Which ones they go the way they go?
Maybe just to start, before you decide you want to make investments, you need to understand what's your risk tolerance. Fund managers usually have an investment policy statement. Basically, you're saying, what are the returns I want to have? How long do I have? Am I young? Do I have 20, 30 years of work or income generation? What interests me in terms of investments? Do I want to limit myself locally or globally? So sit down with a financial advisor like James. He will explore all the universe of investments and then develop a policy. Say, this is what I want to be doing. Based on my risk tolerance, this is what I can accommodate. And then from there, just start executing. So in terms of capital preservation, you're basically saying, I do not want to lose money. You have a very conservative risk profile. So if you have a very conservative risk profile, most likely you'll invest in money market funds or fixed deposits in banks, which will give you a basic rate. Now, there's no zero risk. There's low risk, but you can never eliminate risk. For you to earn a return, there must be some risk. So money market funds, government bonds, treasury bills are the lowest risk investments you can make. Even in finance, we call them risk-free. They're not risk-free, but really, they're the lowest risk. And therefore, you invest your money there. What that does is that your return is lower. That's the other point. Now, if you're more aggressive, if your risk tolerance is higher, you will see your portion is more into equities. Last year, Kenyan equities made an extra 900 billion shillings. They started at about 1.8 trillion. The NSE ended at around 2.9. 900 billion. Even when invested in an equity fund, it was over 45%. Now, that is someone who's willing to incur that risk. Does that mean this year it will go over 40% again? No. Because past performance is not assurance of future performance, right? But that was someone who was saying, I'm willing to incur the volatility of the stock, and I'm willing to put more money in stocks. That's someone who has a higher risk tolerance than somebody who just says, I want to put money market funds and bonds. So people oscillate. Of those two, those are the major risk tolerance levels people have. And the higher your risk tolerance, the greater the chance of the returns, but that means you're willing to have a stomach for all that ups and downs that Sam was mentioning. Thank you.
And for me, when I look at all these investments, I see it like a football match where you cannot say assuming now we are watching the World Cup right now, final, we cannot say the team, because the goalkeeper is so good, this team will win. It's a whole team we have the goalkeeper, we have the defender, we have the striker. There are some investment that you will take that are zero risk. There are those that you will take that are high risk, and there are those that you will take that are for protection. And this is where now the investment policies from insurance companies come in. What do I want? What is my goal? And something that I also like saying, when you are determining about the time limit, have in mind, don't just chase the percentages. Also look at the goals that you have. Do I want to have my child go to school? Do I want maybe to have maybe my first 2 million shillings in an account for the next 10 years? Which product will I take? Sit down with a financial advisor, break down your payslip, and out of that, determine how am I going to execute my financial, those baby steps, to financial freedom. What do I need in my portfolio to actually achieve what I'm foreseeing in my future? And also what Dennis is saying, what is your, risk appetite? There are people who would say, by the way, if this percentage is being given here, I will chase it no matter what. I don't mind losing along the way, but I want to just give it my best. So it's more of a whole team where you just diversify, I want protection, I want defense, I want something that is really going out there. They are chasing the goal, chasing the percentage. Have a portfolio that have several of all these investments.
All right. Thank you. Just changing gears a little, and back to you, Sam. In terms of, you've mentioned you're a global investor, having invested in investment options beyond Kenya. Could you take us back to the first time you decided that you want to actually explore the international market in terms of investment, and what drove you to that? What pushed you to that? What gave you the confidence to enter the market internationally?
Okay, I'm going to be vulnerable. I'm going to be honest. I won't say I sat down somewhere, nikisoma gazeti, I saw an international company and decided to invest. No. I was in campus and I was doing my paper, my project paper. And I was doing computer science. My project paper was on blockchain. That's the word I was looking for. You can see where this is going. So when I was doing my research on blockchain, blockchain voting system, stuff like that, of course you're going to run into cryptocurrency, you're going to run into Bitcoin and all that. And so at that point, I felt, this Bitcoin seems like a very good thing to look into. So I went in. I remember at that time, my parents used to give me pocket money like salary, I think to build up my responsibility and that kind of stuff. So I took some money from that salary that was supposed to pay rent and I put it into Bitcoin, and I lost all of it in one day. And that's when I started to realize, this thing is too risky. What can give me better returns, but not as risky as crypto? And that's where now I landed into stocks, ETFs and all that. And I started following up on them. Now, having the background of engineering and tech and that, I just love reading tech articles. It came naturally that I would follow some of these stories around. So I used to read articles about what Microsoft is doing, what most of these companies are doing, but also starting just to read about the companies behind the big companies we know. So when you hear about something like AI, the first thing you'll think about is maybe OpenAI or Anthropic, the guys who create ChatGPT and Cloud Code, Sindio. But there are so many companies behind it that many people don't know about. So you ask yourself, okay, what do we need for AI? And the first thing that comes, you need compute, you need data centers. What do data centers need? You need chips, you need cooling for the systems, you need storage. And then now you look into the supply chain. Who supplies storage for data centers that run AI? you get some companies, you ask which public companies are listed that do this. And so when everyone is buying into AI but buying into the big companies, you look down into the small companies. And that really now drove my interest into a lot of things because I realized there was a lot of potential in what was happening. At the time when I was in campus, blockchain was the one that was hitting. AI came to hit a bit later. And so when you did that for blockchain, you also realized there were some companies that were doing that over and over again. And I realized there's actually a lot of potential here. In campus, when you're thinking about all these things and you see the MMFs, that time, I don't think they were capped. You could find MMFs with 15, 16%, I think. But when you compare to what you could get in these markets abroad, which is honestly infinite, just depends on how you invest, then it became a clear opportunity that this might be a good place to actually, grow your money. But I'd also like to belabor the points that have been stated here, especially the point on your risk profile and not chasing returns. Now, of course, when you hear Bitcoin, I'll say, honestly, me, I was chasing returns that time. I was looking at people and I'm like, hey, if someone invested in Bitcoin in 2010, right now, have you seen those memes? Right now, you'll be a billionaire. I'm like, I want to be a billionaire. Who doesn't want to be a billionaire? But when you start chasing those returns, you quickly run into now the problems I ran into. Number one, as much as I was doing this for a school project, I didn't understand the fundamentals completely. And this will happen for everything. If you're running into stocks that you don't understand completely, it will happen to you. Like you'll get into stocks that are overbought and they will fall, and then you'll start asking yourself questions. So I think that's a very important point to note, that you can't just be chasing returns. You have to have a very good distributed portfolio that is able to help you achieve your goals, as have been said. When I invest, there are certain things I look at. Number one, I say investments are affected by personality. So that's more like risk, your risk appetite and things like that. Your current circumstances. So if two people are here, one person is coming from a rich family, and you know you are the one who's going to make your family a rich family, then you can't invest the same way. Because if this guy goes into a risky investment and something happens, they have some money that will prop them up again. But you have to be a bit more careful about how you deal with your things. So your current circumstances, your goals. All of us don't have the same goals. There are people like here nowadays, everyone wants to buy a GLE, but now there are people who want to pay for their siblings' school fees. Those two people will not invest the same way. And I'm not saying there's anything bad with it. I'm just saying even how the goals you have direct the way you want to invest. And of course, your predispositions. Like I'm in tech, so I'm predisposed to tech and all that. So I think when you look at all these things in that particular frame, and then you sit down and actually create a good plan about how you want to invest and distribute your money across the different classes that are there, I think that is a better way to invest than saying, I had this guy talk about stocks, and I had him say something like 35%, I'm definitely going to run there. Or you had equities give 40%, 45% in another year, and you run there. After all, I think what has been said here, consistency is the key. Because even when you start moving money around, there's something people don't really factor in, and that is fees. Every time you move money out and move money somewhere again, there is fees that is factored in, and taxes and all that. So if you want to really profit from compounding, I think that's one of the things that you really need to do. But in short, yeah, that's how I landed into stocks. And it's been a rough journey, but a good journey nonetheless.
All right, thank you for that. Dennis, to you, speaking about the principle of diversification in terms of protecting your investments. In your line of work, of course, you have seen lots of money, cross-border like transactions and all that. What is the one thing that fund administrators like you do and understand about diversification that young professionals don't? So, because most of us probably have invested in maybe just one or two avenues. So why is it very important for us to observe this principle of diversification?
Thank you for that question. Diversification is part of risk management. If you're chasing returns, that means you're bearing risk. And if you're bearing risk, the question is, how do I minimize that risk as low as possible while still ensuring I earn the returns that I want? So if you put all your money in one or two baskets, if anything happens to one investment, you'll incur a loss there. But if you spread your investment over a wide array of assets, then you're looking at, if one asset has an issue, at least you have 80%, 90% of your assets that are still generating returns. So diversification is really about risk management. It's about making sure that your return is, for the risk you're taking, is more stable. Now, the key thing is you're not just diversifying for the sake. As mentioned, individually you need to have a policy. What am I diversifying into? And then from there you execute. You have to look at, is this an investment that's regulated by, let's say, the CMA, Capital Markets Authority, Retirement Benefits Authority, or any other regulator? How is its past performance? Am I willing to bear that risk over the long term? How soon do I want my money back? So all that influences the investments you pick.
All right. And even as we diversify, maybe to you, James, what investment options are best for like short-term, quick goals, for mid-term goals, and also for long-term wealth creation goals?
Great. For me, when I talk about short-term, I talk about 0 to 2 years. And that means money market. We have treasury bills. We have the special funds because now they fall, all of them fall under 1 year. Let me say, depending on your goal, short term would be money that you can put your hands on. And I teach this a lot when I talk about when you have your portfolio, have money that a day of adversity, and they always come where anything comes that derails you from going to where you work every day, that's an emergency. Have a portfolio, it's growing your money is above inflation, and inflation is about 7.5%. Any investment portfolio that has below 7.5% per annum, your money is losing value. Assuming you have a 20K January, uende kutoa from the same account at around December the same year, what you can buy with the same money will be lesser. Then if your money then has a percentage that is lower than 7.5%, then your money is draining away. So money markets are good to start with. I come to treasury bills, though right now they are so low. I may not advise for anyone to go for treasury bills around this time unless you really want to buy them. And also the special fund. The issue with the special fund is you build your money market to a level where you can be able to have a fund for the special fund. Now, medium term is now 2 years to 5 years. And when I talk about this, I talk about there are some bonds. We rarely have bonds that are 5 years, but if there is a bond that is 5 years, in any case, then we treat it as a medium term kind of a product. And then we have some special product with the insurance companies. I think Britam has Imarica. ICLN is more, I'm familiar more with them. They have an investor. It has a 10 to 12% per annum constant, but it's more of a 3 to 5 years product. It gives you the discipline to plow in your money there, but also it goes to around 5 years. Anything above 5 years now, again, we go back to the bonds, to the every other product that now falls above the 5 years. But for the short term, I like talking about have money you can put your hands on, but also have a portfolio that you cannot touch your money up to a certain period of your life. So have both. It's like the way I was talking about short term is more like a safe parking. When you have your car in a very safe, good garage parking, then you don't expect it to win a Formula One tomorrow. It's there, it's growing, it's safe, you can access it. But now when you want to go long term, go into something that is giving you better income, but also you shoot your arrows further with things like bonds and all that. Yeah.
All right, thank you. Now speaking about access, how to access these investment options. Sam, you spoke about how nowadays the barrier to access has been lowered. Could you explain to us how, if for instance I'm seeing how AI is growing, the AI business, and you've talked about the whole ecosystem of AI, different companies like NVIDIA. If I want to invest in a company like NVIDIA or Apple, how can I access that?
Yeah, I think it's true. The barrier to entry has really gone down right now. I know if you wanted to now invest in something such as NVIDIA, or there's another US stock or US company, or even a company in China or somewhere else that you think you have maybe done the fundamentals and you think is going to do well, the step-by-step would be, number one, to go to a platform that allows you or exposes you to such. And I know right now I can speak about 3 that I know of. There's Ndovu. Ndovu was a startup, I think still is when I started engaging with it. And that offers you mainly ETFs, but they've also added stocks and all that inside there. There's what we call international brokers, interactive brokers, IBKR. And then there is HISA. Now, I haven't really done much with HISA, I just know it exists. But for the other two, I think I've interacted with them a bit. The easiest for any person who is just starting out, I would say, if I was going to advise, I'd say is Ndovu, because they handle a lot of the complexities for you. So what you do, you just go, they have an app, you go into the app, you register, you put in your name. Nowadays, I think they have, it's just like a bank. You need to put in your KRA PIN, you need to take a picture of your ID and something like that. But when you finish that sign-up process, which is probably 5 minutes if you have your ID with you, then you're good. I think there's an approval that came in after that was introduced recently, but after you're approved, which I don't think takes more than a day, you're good to go. And if you have M-Pesa or a bank account, then they give you details about how you can load your wallet on Ndovu with as little as 5,000 if you're thinking about electronically traded funds, ETFs, or stocks. I think the minimum is 5,000, but they also have other funds inside that allow you to invest even as little as 1,000 shillings. And that's a good thing to do if you just want to test how the market is, and I'd encourage you to do that. Maybe just do a cycle, especially if you're new to this. Just make sure you can withdraw your money from any platform you put it into. I think this is just a general rule. Just put in some kidogo money, wait for like a month or two, and then withdraw. Once it gets back into your account and you can see this is my money here, fantastic, now you can go forward with that. So I think Ndovu is a very easy platform to go to and to start with, especially when it comes things ETFs and stocks. There are a few things I might mention. Number one, Ndovu has a very limited selection of stocks and ETFs. And I usually say that's a blessing and a curse at the same time. A blessing in the sense that sometimes when you have so many options, your probability to make a bad decision is very high. So sometimes just having a very controlled set of options is good. But then maybe bad because if you feel a bit more adventurous and there are companies that you want that are not there, then you might not be able to do so. So that's why now IBKR comes in, interactive brokers. This is a huge company, it's international, people from all over the world use it. And it's an actual exchange service that people use. And most of the stocks and ETFs in the world are there. You know, if you can name it, if you can Google it, it is there. And that's a good place to go if you really want to get in depth with these things. Because now you are exposed to all these things, you need to have your good fundamentals. So the good thing about that is that you have very tight control of everything that you want to do. If it is a stock, you can get in and get out whenever you want. If it is an ETF, you can do that. You can distribute your money however you want. So that's the advantage of that. They have different fees, yes, but it's good, especially if you are becoming a bit more sophisticated in your investment practices. But yeah, those two I think are very good. With Ndovu, you can get up and started in less than a day. So I think that's a very good thing that has happened to us.
All right. Is that the same case for also local options that were once very hard to access, like the Nairobi Stock Exchange?
I think that's true. I think everyone has seen something about the ZD Trader in the Safaricom One app. I think that was revolutionary. I've never really tried it. Every time I want to try it, the market is closed because I get on it when it's night time. But I think that's interesting because that means anyone now can invest in any stock in Kenya at any time they want, of course, when the market is open. So I think that's a very good thing. And even the fact that NSE introduced that worldwide ETF, so that even if you're a bit more wary about taking your money outside the country, you still have an option to participate in global markets just using the Nairobi Stock Exchange. So I think that's good. And that's an opportunity previous generations never had. And I think it's a great opportunity for us in terms of just adding that to the wheel of our wealth building engine.
All right, thank you. James, maybe personally speaking, could you give us an example of one of the worst mistakes you've made investment-wise, or even one of your clients? Okay, if you could share, that is, if it's not confidential. Yeah.
Ask me that.
In your worst investment mistake that you've made and what you learned from that.
For me, the worst mistake I've done, actually, I remember I was working out of the country 2008 up to 2011. And by then I was earning in dollars. And I just got these guys who were like, we trade in Forex. So we know how much we expose in the trade. And out of that, we get a percentage and then we share with our investors. And I remember that time I did $1,000. And I think at the end of the year, I withdrew $1,800. So my $1,000 had gained $800. But now I had spoken to a friend of mine what I'm doing with my finances and about this investment. And this guy, he told me, no, James, I just want to do $2,000. He was also a Kenyan working together with me. And he did his 2,000. Now, when I withdrew, he got in, but now he lost his money. So it's not a mistake I did, but actually it's a friend of mine who invested in that. And I think from that time, I became very risk-averse in anything Forex that has Forex in it. So, and this is a place where the way I was saying, over the years, that was way back in 2011. Over the years now being in the world of finances, I usually tell people before you invest, anything that you cannot explain what they do with their money, the way you were asking, where do people put in how do companies give percentages for their money markets? We know where they invest and how they give their percentages. So if you are investing to any company, what is their fund size? Are they regulated? All these details, who are they? How long have they been in the market? And I think that is when now I started doing my due diligence. Before I put in any shilling, I just want to know details into how that investment works. Every investment is a risk. You can lose money, but I usually say I can't afford to lose any shilling. I just want to do my due diligence, read the way Samuel is saying, read articles, and the good thing with nowadays is that there is information in our fingertips. You can be able to Google, if it's a company, just know what are the complaints with their clients out there. Because if 2-3 guys are complaining about anything, most likely it's true. So for me, I would say I've done mistakes, but I think that one was more of a friend than me directly. And for me, when I worked abroad, and I have few clients who are abroad, I think I was also sending money to a relative to deposit in a circle. By then, the online banking was not very common, and this person was maintaining their fleet of matatus. So when I came, I got my money. Most of my money had actually vanished. That is not an investment, but rather a place where I trusted people with my money, but actually I lost money. But in matters investment, I'm very careful to actually put my money anywhere. Yeah.
All right. Dennis, speaking of investing 1,000 and maybe getting a return of 1,800, could you tell us, even from the perspective of a fund administrator, where do you get the extra profits for some people who don't know, so that we are also able to differentiate that from some of these other schemes like Ponzi schemes, Bitcoins, we don't know, so that claim that they can be able to multiply or 2x your money or 3x your money. So how legitimately do you increase someone's return when they invest a particular amount of money with you?
I mean, if I put 1,000 and I get 1,800, sign me up. I want that one. I'll want to be in that one. There's the old adage, which I think is quite true. If it's too good to be true, it possibly isn't, or it surely isn't. I think we've seen both locally and globally people who are promising, 25, 30, 40, 50% reassuringly and consistently. Usually those are people who are doing something else on the side. In fact, even if someone comes in this market and says 50% guaranteed, even the regulator will go knocking on them and saying, how are you generating this money? So you must, as mentioned, when you're making investments, it's also due diligence. What James said, someone comes to you and says, this is the investment I'm doing. Are you interested? The first thing you need to say is, what exactly are they putting their money into? what's the underlying? If it's a real estate investment trust, they're putting money in property, fine. If it's an equity fund, they're investing in stocks, either locally or globally. But anything that has a black box, you're just putting money in and you don't know how they're generating, that is a big question mark. Number two, you have to look at regulations. There's a lot of regulations that goes into investments, even in money market funds. In money market funds, the person who's developing that product doesn't have access to the accounts where you actually put your money. Between you and them, there's a trustee, somebody who makes sure they actually invest in what they've said. If it's money market, they're not going to put it in something else. There's a custodian, it's a bank where actually the money is held. So sometimes, even the person marketing to you is not the one who will handle the bank account. So from a regulatory standpoint, there are things which have been put in place to make sure that people do not lose their money or are exposed to risk they do not want. So the first thing under regulatory perspective is, who regulates this product? Who's your regulator? Is it the Capital Markets Authority? Are you regulated? Can you confirm? Can you give me a certificate? If it's something for pension schemes, is it something that the Retirement Benefits Authority has already approved or given a no objection to? If it's something under the NSC, is it something the Nairobi Securities Exchange can confirm it's a listed entity or it's listed on the exchange? So you have to do your own due diligence to make sure that you understand it. And then from there, talk to a financial advisor and see how it fits within your investment policy statement. The investment policy statement is what you use to execute your investment strategy. And you can review it once a year or with your financial advisor. But if you start just putting everything because you're hearing this and that, then you'll not be able to generate value. But if it's too good to be true, chances are it's not.
All right. Sam, speaking of regulation, how is the international finance markets regulated?
So from two sides. Of course, if you're doing international from Kenya, then you have to look at the platform you're using to tap into those international markets. So for the platforms I've mentioned, IBKR is not necessarily a Kenyan company. It's just a conglomerate big company that does that. That one rides on credibility and regulations from markets that they've actually needed to be regulated from. But now when you speak about Ndovu, which is domiciled in Kenya, they are regulated by Capital Markets Authority. So that's good. So that means even the platform that you're using, number one, is regulated by CMA. But then you go into now the stocks and the companies that you're going to invest in and the electronically traded funds that you're going to invest in, then you have to look at that regulation from their side because those stocks are not domiciled in Kenya, they're domiciled elsewhere. So if you're investing in a company somewhere, you have to know if their fundamentals are good, if their policies are okay, all that. Just make sure you do your due diligence when you invest into companies from that side. So that's one advantage of just using a brokerage firm to do that, is because if you're going through a brokerage firm that is in Kenya, then part of their mandate to get that regulation is to make sure that those things are catered for. So I think that's the upside of that.
All right. And finally, Henry, speaking of tax, even from your experience as an auditor, what are the worst consequences you have seen when people are unaware of tax and regulatory compliance in regard to investments?
Yeah, thank you, Stacey. The hallmark of audit is usually a very, let me call it rough assessment by the commissioner. You have invested, or rather you have made a transaction, but you are not aware of the tax obligations, like the one for Naivas, the one that I've just mentioned. A very simple transaction. I mean, so we are just selling a shareholding. Yeah, so I'm just selling. I am in Mauritius. But you forget that your directors, management and control, they are sitting here. So of course that has the tax implication. You'll be now having the tax assessment. So what I find mostly is out of, let me not call it ignorance, but lack of understanding of the tax obligations. Of course, they will lead to the assessments and which come with penalties and interest. So before you make any investment, understand the tax obligations. Whether you're investing locally or globally, I'm sure some of you have heard of, or you would ask about, so if I am investing in a US-based company, or I'm investing in a UK-based company, and they tax me there, will I be taxed again here? So those understanding a framework like the double tax agreement. Kenya has tax agreements with other jurisdictions, especially on their taxation. So if I'm investing in a US-based company, is there a double tax agreement? Is there a double taxation agreement? Should I invest in a UK-based company or should I invest in a US-based company? So understanding those frameworks is very important, especially for the security of your investment. So understanding your tax obligation is very important.
All right. And what are the provisions to prevent double taxation? Could you give us a few, also some tips and hacks on how to reduce some of the taxes that are due for these investments?
A double taxation agreement is a very interesting framework, because now if I'm investing in a US-based company and I am receiving a dividend, I think they tax it at a withholding of 30%. So does it still apply in Kenya? But if it doesn't apply in Kenya, sorry to mention that again, you will be taxed. So if Kenya has no double taxation agreement with another jurisdiction, you will bear the tax liability. But if I am investing in Germany, let me mention Germany, because they are listed, it's one of the listed company, or it's one of the listed jurisdictions that Kenya has a DTA. So if I'm investing in a Germany-based corporation, they tax me as an unresident. I'm receiving my income from here in Kenya, but I've invested in a company which is there, and they tax me at the applicable rates. So the commissioner allows me to apply for those foreign credits. So at the point of paying my final tax, I'll claim those foreign credits that have been taxed in another jurisdiction. High likely is that you will get to be taxed, probably not double, but you get to be taxed from both ends. Yeah, so I think that's very important.
All right, thank you so much. At this point, I'd like to open up the floor to questions, and we'll take around 4 questions. I can see a hand there. Elvis, if you can help me with the mics around. You can start with her, then back there. Then there's a hand here.
Check.
So we'll take all the questions at once, and then maybe the panelists, you can note them down so that you can see which question you will answer.
Okay, good evening. My question goes to my brother James. Am I audible? My question goes to Brother James. I would love you to share a little bit about the private wealth and the balance fund, and which one is more suitable between the private wealth and the balance fund.
Sorry, we can't get you properly.
Check. Okay, good evening. My name is Luvai Vitalens. James, I would love you to share a little bit about the balance fund and the private wealth, which is suitable for short term in terms of liquidity and risk management. And then to my brother Henry, I'd love you to share between the two, which one has, in terms of tax. Could you explain how tax is applied to both the balance fund and the private wealth? Thank you.
All right, thank you. There's a hand here.
Thank you. I'm Neema. My question is to Sam. Are you familiar with crypto trading? So how do you download your funds from your wallet? Like, for example, if you want to transfer from your wallet and you want to invest in something, and then the next gentleman to you can tell us how you can assist us to deal with the taxes that come in. For example, if you have a crypto wallet, yeah, and maybe you've made enough money and you want to buy a property, you want to download that money, it has to go to an account somewhere, maybe a bank account, so that you can buy a property. So how do you go about it? And since Sam is already familiar with that, how do you do that? And how do you pay your taxes? Just basically you just combine the system so that some of us can know how to go about it. And other than that, for example, to all of you, you may have to answer it at your own time. If you have a specific amount of money, like today, if I was to give you something like maybe 15 to 20 M, where would you put that money? Yeah, where would you put it today? If you have access to that money, where would you put your funds into? Thank you.
All right, the last question here.
Yes, good evening to you all. I have about 3 questions. Question number 1, you have spoke of these multinational companies. Over about 4 months ago, we have been having issues na PayPal. So let's say, for example, the gentleman with nywele mrefu mongelea kuhusu Microsoft. And Microsoft being an American company, for you to buy the nini with it, I think you have to go through PayPal. So you load your PayPal account, then ndio unanunua. So pia wakati wa withdraw, you follow the same process. Now, kuna rafiki yangu, sio mimi, pesa yake ilipotelea hapo kwa PayPal. Now, how do you advise us to mitigate your risk yenye ku involved there? And then number 2, I don't know who should I direct the question to, but I think both of you can respond to it. Why is it more secure to invest, let's say, in a security exchange like the London Security Exchange or Nairobi Security Exchange? Which one is more secure for me to invest in? I think, then the last question, now, can I approach money market as a source of income for my day-to-day operations? Ama ni ya kufanya tu kama side chick kind of an approach? Asante.
All right, I think it's a side hustle.
I also have 3 questions, but I wanted to congratulate the panel. You did a good job. I'm hoping you'll do this again when we have done our homework and we come back with more questions. And thank you, moderator. You did a good job too. I wanted to ask number 1, are family trusts taxed? Meaning, if I want to invest and I don't want to be taxed, I know that's a crime, guys, it's a crime. But if I take my investment and put it under the name of my trust, will I still be taxed? Secondly, about buying bonds. Is it beneficial to buy bonds in the second-hand market? Like, let's say I have money right now, but I can't wait for the bonds to be advertised. So is it a good idea to buy on the second-hand market? And then thirdly, is angel investing a way of diversifying your portfolio? Is it beneficial for me as an investor?
Stacey, I think we can handle those and then we can move to the next bunch of questions.
Yes, so I think we can have the panelists answer on those.
Yeah, so I want to start with the person who asked about the balance fund, the difference between the balance fund and the private wealth fund. I hope I got you right. The balance fund is where a company gives you, let's say you deposit like 10K, or you open an account like a money market, but you choose the balance fund. This is where the company chooses between the bonds, the stocks, every kind of investment that is out there in the market. They choose which one is doing well at what time. They invest through that. And for me, that is, I can say it's a medium-high risk, because if a company invests into stocks and then there is a dive, there's a likelihood you may lose some money, but also it can go so high, higher than even a money market. And what I usually look at when I think about the balance fund is to look at the company and their track record into the percentages they have given over the years. And that way you will be able actually to know, do I go the balance fund way, or the private wealth fund is where now they pick one product and then they run with it. Let me say like a treasury bill, a company that is very careful to actually with the way they do their investments, they may go to the bonds or to the treasury bills. The rates is lower, but actually it's a very low risk kind of an investment. So balance fund and private, they both it's the way they expose the fund. One, you can make very high income. The other one, it's always plateauing at a certain very comfortable rate according to what is happening in the market. So let me see the other question that I can be able to handle. There's someone who asked, no, I want to pass crypto to Sami. So there's someone who asked, if I have specific amount of money, let me say like, and I want to be very careful, because when we say specific amount of money, I usually say, let me say I have 300K in my account, and I want to go for the special fund. Now, you need to actually determine if tomorrow I have an emergency and I need quick money. Most likely, I will need to have money that I can put my hands on, like a money market. But now, let me say I have, let me just give an example. I have half a million in my account, and maybe that is a specific amount of money that maybe you are talking about. These are money that I can divide between, money market I usually advise have between 3 to 6 months your monthly expenses. That means if I lose a job and I have invested, I will not go to knock the door to have the money withdrawn. Have money that can sustain you for 6 months. And then have 250 in a special fund. That means if an emergency comes, my car battery has gone down, I need to be jump-started every morning to go to work, it will inconvenience me. I have an account to go and withdraw there, buy a battery for my car, for my life to move on. But have money that you cannot be able to touch for like 1 year. And that's why I said it's like a football team. Have money that is defending, have money that is striking. Earning more money, maybe maybe a Ndovu account, somewhere that you want to hold on and let the market do its work over time. But have money that you can access. Always divide your money across those few accounts. There's someone who talked about a side chick and a money market. So let me come to you. Money market, like, can it give you an income? I want to talk about someone that is so close to my heart who retired. And actually she asked me, James, there is this lump sum that I've been paid, but there is this money that I bought an annuity where I get an income for the rest of my life as long as I'm on this earth. We call them an annuity. Now, the lump sum they get, I told them, now, can you put in a money market? You can access this money, but actually you can let it go to 1 year so that you may be withdrawing just the interest, and then you let the principal money to continue making you money. So if you want a money market to become an income, you may be talking about maybe some several millions into your money market. But if you have a 50K you want every day, you go to the app to look how it's doing, it may make you 3K per year. And that may not convert into a good side chick. It could be a side chick that is very dependent on you. Yeah, so money market to make you money, maybe you are talking about a bigger amount of money to invest there. Yeah, so I think those are the few questions. I think the trust fund, you talked about the taxation on trust. I love trust because it's more like a safety nest where you control your wealth, but I want to hear maybe about the taxation bit of it. But I love either family trust or cash trusts, because a family trust can include your businesses, your land, everything that you have, you put it in a trust. There is a tax benefit to it, because when you withdraw your money from a trust, even if it's your money, you gain a tax benefit. I know it's there, but again, I want to maybe go into details. I know it's something that I love handling, but maybe more details, maybe I can explain more if Henry may not be able to go into the depths. Yeah, but I love how you are thinking about, like, and anyone thinking about trust, you are thinking more of generational wealth. Like maybe there's an Andrew Carnegie Trust that we know of. It educates children across the world, and this guy passed away so many years ago. Only a trust can be able to carry wealth from generation to generation. Yeah.
Yeah, let me go next before I leave the heavy questions to Sam and Henry. Looking at the 15 to 20 million, as mentioned, I will look at my investment policy statement. What I like doing is, before money comes, you have to have a strategy for it. And so I will look at my investment policy statement. Either I already have an execution plan, a certain amount to MMF, a certain amount to stocks. I personally keep a moderate to aggressive risk profile. So that means I'll put more money in equities, and also look at ETFs, especially if you want exposure to certain sectors. So you'll find a way of diversifying it across that pool. But we try and avoid that situation where the money comes and then that's when you're thinking, because that's when the devil also brings the ideas around that same time. On terms of whether the London Securities Exchange is more stable or better than the NSE, I mean, it is an exchange. It's in a different jurisdiction with a different regulator. And what an exchange has, it's a pool of companies who have offered their shares to be traded. And so it isn't whether one is better than the other. The question becomes, what do you want to be exposed to? Which businesses are you targeting in that exchange? Are you making a bet on the UK economy? And in so doing, wanting to invest in the LSE, are you aggressive about the Kenyan economy, and therefore are you betting or placing your investments in the NSE? So it's not about one versus the other. It's about how it reflects your investment rationale. In terms of the last one that I think I can do, which is the second-hand bond market and angel investing. Angel investing is one of the highest risk investments you can make, and is usually by moderate to high net worth individuals who want to invest in early stage businesses which they believe have a chance of growth. And the probability of failure for these businesses are very high, because an angel investor is basically, after the promoter of that business has put in his money, friends and family have put in, the angel investor comes in. In fact, the angel investor is before the venture capital, before the bank, before private equity. So you're bearing a lot of risk. Usually it's equity, meaning there's no security for what you're giving. So usually that's a realm played by moderate to high net worth individuals who want to back businesses they believe, based on their own experience in that market, or as businessmen or women themselves, they want to invest in those businesses. In terms of the second-hand bond market, there are two types of players in the bond markets. There are those who just invest for the return. They don't want to trade. And then there are those who trade, who want to make an extra shilling from buying and selling of bonds. So if you want to engage in that secondary market, you must have that knowledge of, am I buying to hold or am I buying to sell? If you're buying to sell or to trade, then you have to look at the interest rates, how that affects the movement of the bond prices. But if you're buying to hold, you're just seeing the return is nice and you want to buy and hold, yes, then you can go and buy in the secondary market, because you buy and hold it for the return, and that means you might hold it all the way up to maturity. Thank you.
Yeah, let me respond before I leave the difficult ones to Brother Sam. Yeah. So the first being on the balance fund from my brother, I view taxation from an income accrued perspective. So where have you, or rather the income that you have received, how is it taxed? So if you have received a dividend income, there is a withholding tax that is applicable. But now there is usually a withholding tax when it's final tax, and there are instances whereby withholding is a final tax. and there are instances where withholding is not a final tax. So meaning that at the end of the year, you can claim the withholding tax credit. So in this perspective, for a balanced fund, the withholding tax is not final. So once you have your, you have received the dividends or the funds at the end of the period, or the time you are investing, when you come to pay taxes, if it was taxed at 15%, and of course taking in their shareholding, the control, if it's a 12.5%, if the company that you are receiving the dividends for controls 12.5%, there will be no withholding tax. But if there is a withholding tax whereby the resident is not controlling 12.5%, the withholding tax will be considered as a tax credit, and your dividend income will be considered as other income. So when you're coming to pay your taxes, you will declare that dividend income as other income, taxed at the normal rate, 30%, and at the end of the day, you claim the withholding tax credit. So if your 30% of the other income comes up to around 100,000, and there was a 15% withholding tax credit, you will less it from the 100,000, and then you pay the rest, the net tax payable. The other one is on crypto wallet. I'm not sure, Stacy, whether we have sharp boys here who do, or Sam is one of them,
Sam.
who do, someone mentioned about PayPal. So you are earning income from an unresident individual, but you receive it through those platforms. You receive it through PayPal, or you receive it as, I'm not so sharp on cryptos and all that. I see it from a perspective of the purpose of, or rather where the income, how the income was generated. So if you have received, let me give a practical example. If you have traded and you have been withheld, and the money goes to the PayPal account and all that, you will withdraw it normally. There will be no tax obligation to that because it has already been taxed. But when it comes to maybe you're being paid now, either 23 or 24, can't recall, called the significant economic presence tax. So it says that if you are receiving income from an non-resident individual, and this non-resident individual do not have any premises here in Kenya, they do not have any infrastructure in Kenya, you'll be taxed at 3% a significant economic presence tax. So I would want to take the discussion to that side, but we can check again. For the family trust, trusts are very, I call them tax-free infrastructures. The income tax, in the first schedule, trusts are usually exempt from taxation. So if you are receiving an income, or rather if you are receiving an income from a trust, there would be the element of a withholding. There is the element of qualifying and an unqualifying. So the dividend that you receive, it could be a qualifying dividend, and in instances where it is a qualifying dividend, the withholding tax to that is usually a final tax. So I think for me, I would not want to talk more of family trust, but it's an income exempt framework. The other one was on if I had 20 million. If I had 20 million, I would probably trade in the NSE, simply because I find that investment infrastructure being liquid. For me, and in an investment angle, I look into the liquidity. How quick can I translate my investment into a liquid cash? So I would invest in an NSE listed entity, or even go further, invest in an SEZ entity, in an SEZ entity. So maybe, or rather, you have a company set up in an SEZ zone, and then it is listed in the NSE. The dividends that come from that are usually exempt. So maybe there is a company that is listed. There is a company that is trading in Traffic. Traffic is in Kiambu Road. And they are listed in the NSE. Any dividend I'm receiving from that, we consider it as a tax exempt. So you can also consider, or rather, you can also think of investing in the SEZs, you understand? Those companies that are in the SEZ, yes.
Finally, the hard questions.
First of all, for those who are wondering, SEZ means Special Economic Zone. You can Google it. Thank you for the comment on the hair. I was told I took akili ni nywele literally. I think it is working well for me. I'll start with the question. So the first one was on crypto, withdraw. I think I'll answer it from both sides. How do you get money in? How do you get money out? And what he's spoken about the tax. I'll just say something about that. So number one, depends with the platform you're using. So I know right now there are so many platforms out there. Biggest ones I think is Binance, some of these exchanges, Coinbase, something like that. And by there, let me just say this here. Not all crypto is a scam. It runs on blockchain. If you ever send money abroad, chances are that system you're using uses stable coins to power your transactions, cross-border transactions. So it's actually something that is really useful and is being used. Anyway, yeah, so for the big platforms, maybe Binance, Coinbase, a lot of those, if they are already operating a significant amount of, let's say, customers in Kenya, a lot of them will have some integrations to support that. I know for a fact, Binance now actually, it allows you to deposit and withdraw to M-Pesa directly. Now, sometimes they shut it down, sometimes they open it up, but it just shows you how accessible things have become. If that option is not there, there's something they call peer-to-peer markets. So what that does is it just creates a platform that allows you to withdraw or deposit using another customer's funds. It's not very complicated, it's something that you can get into, and it allows you just to be liquid because of that. And then again, they have card integration. So you can withdraw to your card, or you can withdraw to any other financial service that is integrated into a lot of those platforms. Now, when the platform doesn't have like a big holding in Kenya, like they don't have a lot of people in Kenya, that's when things become complicated. Because now you have to think about how you will move money, and that's why now people start using PayPal and all of these other places and all these other tools, and that becomes a bit more complicated, but it's still possible. But things to note is, number one, if you go that route of PayPal and all these intermediaries, you have to think about the tax implications yourself. For something such as Binance, because I know Binance has a very big foothold in Kenya. In fact, do you know 4 million people in Kenya hold crypto? It's a good statistics to have. But Binance actually integrated some of those tax things into their system. So I think right now, if you withdraw with their direct systems, you'll see a surcharge of tax somewhere there. So I think that might answer that particular question. For PayPal, I had someone say PayPal. I think this is a misstep on my side. I might not have explained properly. You don't need a PayPal account or a special account to invest in these international companies. Like I said, there are two platforms that I know of that I can actually vouch for. That is IBKR and Ndovu. Now for Ndovu, once you sign up, you can transfer funds into Ndovu from your M-Pesa or your bank account. It's that simple. So they give you details about how to transfer money from your bank account to Ndovu account, and then from Ndovu account, they give you a wallet, which you just allocate. Because the money is already in Ndovu, you just say, I want maybe 10,000 to go to this stock, 5,000 to go to this ETF, something like that. So you absolutely do not need to go through PayPal or any other platform. It really lowers that barrier for entry. For IBKR, it's a bit more technical, but you still operate with your bank account. Now, you might want to go the PayPal route if you really like PayPal, but it's not necessary. You just go through the normal bank account route, get into IBKR, load your account in IBKR, and then start allocating from there. So you don't really need to go through all those hoops to get into. So that just means that barrier for entry is not there. So you don't need PayPal at all, unless you really like the company or what they do for you. Security, the question on security, I'm going to assume, because when you say security, I'm going to assume you're speaking about risk. Between maybe investing in something like the London Stock Exchange or the New York Stock Exchange vis-a-vis investing in Kenya. Now, risk is a very, I haven't done finance, but from my research, it's a very abstract thing to put together because it's very hard to quantify completely. we can be peaceful. And of course, markets now, NSE and all these things are controlled by economic factors. So the companies are either going up or going down because of demand and supply, because investment, money flowing into a country, money flowing out, something like that. There's a lot of things that go around these things. So when we talk about something like the NSE being secure or the risk that is there, it really depends on economic factors and geographical factors around here. And I'll give an example. Right now we are peaceful. We are a peaceful nation. People can, go around, do business, trade, and all that. So that means our stocks have been either, we can say at the very minimum, they are stable. But then you go into a situation like Iran. Everybody knows about the Strait of Hormuz nowadays. Manafungua nayo conversations kwa matatu. Umesikia maneno ya Hormuz. So we know about that because of the war that happened there. Now, take that here. If a war was to break out now, the way Uganda wants to take the ocean, I heard that statement was being said somewhere on a light note. But if something was to happen here, then the economic factors really change, yeah? Or if there's an epidemic, the way there's an epidemic going around in Central Africa, things like that affect the stocks in the area because now people are very wary about investing in this area. So I can't really say this is safer than this place or this is safer than that place. And that's why I'm saying now it's really predicated on you following the news and following what's happening in whatever region you're going to invest in. Honestly, when we speak about risk, I don't think there's a place or anything that does not have risk. I know sometimes we even want to trust fall on land, because now we think that land, absolutely no risk. But the way I think about it is, do you know sometimes you can go and buy land, and I know we've had stories about this, and then someone else comes and has the same title deed you have. Sindio, now you have to go to court and start fighting about that title deed and all that stuff. They win or you win. At the end of the day, when you're counting your returns, it is your capital gains minus the court fees you spent and the emotional trauma that you've had to go to court to sort all these things out with. Sindio? And that is land. Supposedly it's supposed to be a safe investment. And it's also controlled by economic factors. I'll give you two examples. There was the 2008 economic crisis that came from the housing bubble in the US. That was real estate. Of course, real estate is built on land. And that is a very big economy whose land and real estate industry just collapsed. And another one many people don't know about is Japan in 1990s, where their real estate, especially in the urban centers, really collapsed. And Japan was a big economy back then. And that collapse made them stagnate all the way up to now. I think right now they're starting to go up. So a lot of things that we think in our mind can never happen sometimes do happen. And that's why you hear people talking about diversification. Diversification is just putting your money and hedging it in different places. The way I look around diversification is, hello, can you hear me? The way I think about diversification is in 4 ways. If you really want to be safe, this is how my research has led me here, is you diversify, number one, geographically. So geographically means if I have assets in Kenya and I have assets in another country. So that if there was anything to happen in Kenya, I can still profit from assets in another place. So shamba zako zote haziko Kamulu. Sasa, so ziko somewhere. You can spread out and see if this happens here, I can still survive here. Sindio? So that's geographically. Number two is currency. So you can invest, you can diversify geographically, but if the currency is the same, and then Kenya's economy goes down and all your investments, whether they're in US or in Japan, when the Kenyan economy starts going down and the currency starts going down, regardless of where you invested, you're also going to be affected. Maybe not as much, but you're still going to be affected. So that's the second slice of diversification. The third slice, I've said, geographically, currency. There are two others. Can you give me a minute? I think about them. But anyway, zitakuja. So geographically, currency. Oh, sector. Yeah, sector. Thank you for that. So industrial sector. So even if you do these two different diversifications, and then you get into a place where you have diversified geographically, you've put your currency different places, but all those things you've invested in different geographical areas are the same sector. It is either completely real estate or completely finance. Then if something happens, like the 2008 real estate crisis, the boom, the crash, which affected not only the US, but every other single place, you're also going to be affected. So when you start to think about diversification in all these places, then it helps you at least hedge yourself against most of the things that can happen. And I think when we look at the economic conditions that are happening in the world right now, wars are sprouting out of nothing. Sindio, this Strait of Hormuz thing has caused us to start paying 220 shillings for fuel. And so other things, so many other things. Fertilizer is actually, there's a shortage of fertilizer, and I don't think a lot of people know that. And that's because one of the byproducts of producing oil is fertilizer. Most of it comes from the Gulf, and that was all affected. And so very soon, you'll see food prices start going up. Nishawana memes, if you have a crate of tomatoes, you're a very rich person, something like that. So that affects the entire thing. So I think when it comes to thinking about security in different areas, you really do just have to, my best answer would be just follow the fundamentals. Of course, London Stock Exchange, New York Stock Exchange are a bit more strong in terms of the economic power, and so it will take a bit more for them to crash. But honestly, now, after COVID, after the wars and everything, I think we should understand that anything can happen anywhere at any time, and that can disrupt us. So even when you're thinking about saving and setting up cash for yourself, and not just for yourself, but even for maybe your future generations to come, you should think about even how to hedge those things, such that when things come up that you cannot anticipate, and they will do, at least you're at a better footing to survive those issues. So I hope I have answered that question. My short answer for that is there's no certain way to tell which place is more secure than the other. Of course, don't invest in war zones, but do your fundamental analysis. When you start seeing things in London and that area starting to become tricky, try to see how you can hedge yourself against it. But it's all about following, especially when you're going to international markets and stocks and all that, you really need to have an initiative to follow the news and be at par with what is happening in the world, so that you know what is happening in the places where you've placed your money. Maybe I'll just mention something about angel investing. It's a good question. I think Dennis has answered it quite well. Coincidentally, in my entrepreneurship journey, because of the things I'm doing, I found myself in a lot of rooms with venture capitalists and angel investors on the other side, looking for money. But when you interact with these people, you actually understand how they deal with investing in companies and all that. And it's very interesting. I'd agree with Dennis. It's a very risky business. I'd put it in the high risk category. But then again, high risk usually means high reward. And when I look at some of these companies and what they've been able to do, it's why they keep on doing it, why venture capitalists still keep on doing it, is they don't just invest in one company and hope that that company is going to rise. What they do their due diligence, but they invest in about 10 companies. This is an example. They invest in thousands, but for example, they invest in 10, and they only hope that 3 will give them an asymmetric risk-reward ratio that will cover the rest. So it means even if the 7 companies I invested in fail, 3 of them will give me enough money to surpass even those failures. So I think it's a very interesting thing to think about, especially angel investing. When you're investing in companies and businesses, it's a very strong proponent for growth. And a good example people usually give is this company called Stripe. I don't know if you guys know Stripe. If you've done any purchase online, e-commerce or whatever, for companies that are in the US or whatever, when you go to pay, they usually use Stripe. It's like the payment company. It's like the PesaPal for US and stuff. So that company started around 2010, Zuko. 2012, their valuation was around $500 million. Right now, their valuation is $159 billion. I'm not talking about Microsoft or these big companies everyone knows, just Stripe. $159 billion. Now, the math tells me that's around 300 times, yeah? The investment that someone put in. If you annualize that, it's about 2,000% per year. If you of course, it's not annual because it started growing at some point there, but if you annualize, it's about 2,000% per year. And the people who went in, the venture capitalists, the angel investors who went in at that time, the amount of returns they're getting, people will say, okay, Illuminati. But yet again, it's just a company that came down and grew. In Kenya, the landscape is a bit different. Of course, we have not seen that kind of growth, but there's actually potential, because I'll give you examples of startups like Dark Analytics. If you get into the startup zone, you'll start hearing about this. So Dark Analytics helps companies that we know, Unilever, most of these companies that sell in supermarkets to do analytics into how their products are moving. And they started raising capital, I think, in 2022. And right now, the valuation, I think, is probably above $10, $20 million. So even if you invested back then, your return right now would be over 300%, I believe. And that's a Kenyan company, and it's not that big. Not a lot of people know it unless you follow them. So I feel like that's something that is very good for someone, maybe if you want to venture into a risky endeavor that can also pay out later in the time. If I was given 15 to 20 million, I think it's always good to have a plan on how you're going to invest. And any money that comes, whether it is expected or unexpected, if it fits into that, if you channel it into that plan, then it becomes a no-brainer. So let's say right now, this is how I do it. I would do it is I have income coming in. I split that income and say, okay, a certain percentage is going to go towards investment. Now, a lot of people say 20, 30%. You can decide for yourself, with your own thing. Decide which percentage is going. Now, you take that 30% and then you slice it up. This is basically how I'd suggest. You slice it up and say, depending on your risk profile, I'm going to, and I think Dennis has mentioned this, I'm going to split that 30%, now it becomes my 100% of investment into slices. So maybe 40% safe investments, low risk investments, 30% medium risk, and then 20% high risk. If you are a very high risk person, you like to live life on the edge, mtu wa twist, you can say 20, maybe 30, 40% high risk, medium risk, and then low risk. And then in those slices, let's say you have the low risk now. I've put my low risk maybe at 40. Then I'd say, okay, in my low risk department, I have MMFs, and I have something else that I can maybe real estate or something like that. And then you split it like that, of course, considering the way they've said liquidity and stuff like that, because things happen in life that you might need money. Even if you have an emergency fund, some things really do need you to go back to your investments. For example, this is what I've seen a lot. When there's a sickness, maybe someone is ill in your family and the bill is so high, your emergency fund maybe can't cover it. So you now start looking at your investments. If you're not very liquid, that can hurt you. Because there's a very big hurt that comes when there's a big bill, you've exhausted all other means, you know you have the money to pay it, but you don't have it at hand. You have 100 acres in Isiolo, no one wants to buy. You see, and you have a bill to pay at that particular point. So it really, the way you classify and the way you split your investments is something that you really need to sit down, think about, and plan, so that when these things, eventualities happen, you're better positioned. Now, I'm not saying that you will always be prepared for anything that happens, but just put yourself in a position where you are better prepared than you would have been if you didn't have certain information. So for me, that's what I do. I take that 20M, because the plan is already there. I just feed it into that plan. So say 20% of 20M is going towards high-risk investments. Medium risk, I'd put maybe special funds, equities, and then high risk, I'd go all in with the ETFs, crypto, stocks, and all that stuff. And once you position things like that, I think that would be good. So I think those are my answers.
All right, thank you so much. Let's give a hand to our panelists. We have come to the end of the discussion. Thank you so much, Dennis. Thank you so much, James. Thank you, Henry. And thank you, Sam, for their wonderful insights. So I'll allow you to have your seats at this point. And just as I mentioned, most of these ones are YPs. So in case you still have more questions or you want to consult, they are accessible to us, even on the WhatsApp group. So thank you so much. And I'll also at this point want to invite Victor, yeah. But thank you so much for participating in the conversation and staying till the end. The difference between you and the person who didn't come for this session, of course, will be in how you implement the information that we have received. So it's one thing to be financially literate, and it's one thing now to use that information to your advantage. So my charge to you is to take action from what we have learned today. Thank you so much, and God bless you.
That was really a good session. Thank you, the panelists, and also Stacy for being good moderator today. We've finally come to the end of our session today, but before that, I have a few announcements that I'd like to pass across. And first of all, for those who are new members, can you please raise up your hand? Those who are not like YP members. Okay, thank you. Thank you for coming and for attending our sessions today. So after the service, unfortunately today we don't have the tea. Someone mentioned about tea. We usually have tea after every session. So unfortunately today we will not have tea. But after I finish praying, all the new members will go to this row, and then they will meet Edith. Edith, are you around? Okay, she's coming back. I think after the session she'll come back and she'll meet you guys here and just give you guys a briefing. Another thing, as I think for those who are in the main group, they know one of us, Mary, lost her mother this week. And as the young professionals, we always support one of our own. So there's a group that was created by Josiah, and there's a link. So next week is when the burial will be taking place. So we are encouraged for those who will be around who can attend. The burial will be... So the burial will be on 1st July. The Mass will be held at St. Teresa Catholic Church in Gesha. I think that's in... and then she'll be laid to rest at Ngeshe in Limuru. So for those who can manage to attend, please, let's go and support one of our own. And then for the group, there's a link that was shared. So if you can join in and then support financially, that will really be a good gesture, even for us as the young professionals supporting one of our own. And then another thing, we will have a joint event on the 25th of July. So we are encouraged to join in so that we can also expand our networks. You remember the last session we had was on networking, and we were encouraged to be able even to utilize those people that are around us. So we can be able to attend that, and registration will start this week. So there'll be an announcement, and then we'll start the registration. And lastly, our next session is on 12th of July, which is the second Sunday of the month. And it will be a continuation of the same on matters to do with finance. So come, be expectant to learn and even to grow. Our main aim is for all of us to be able to grow wholesomely, whether in finances, spiritually, social-wise, and in all areas of our lives. So next Sunday, we are still continuing with the series on finances. So be expectant. We will share more details on the panelists or who the speaker will be as time goes by. So with that, I'd like us to stand up, even as we close with a word of prayer. Okay, let's believe and pray. Heavenly Father, we worship you, we honor you, and we say thank you even for today. We say thank you for such an amazing session that we've been able to have. Thank you for the panelists for even sharing the experiences, the knowledge that they've gathered and even gained over the years, O King of Glory. As the young professionals, our desire is for us to grow wholesomely, O God, in all areas and in all spheres. We pray that, Lord, may you help us not to be just people who take in information, but be those who also are able even to apply that in our lives. We pray that, Jehovah, may you help us even to be good stewards of the resources that you've given us, O Abba Father. That, Lord, even as we head out there, Abba Father, with the knowledge that we've been given, may it be able to help us to shine light even in the world out there, Jehovah. We glorify your name, and we pray that, Jehovah, that even as we live here and we go to our different places of residence, we pray that may you go with us, may you protect us, and may you even watch over us. And even as we prepare for the next session, oh Abba Father, we pray that, Abba Father, may your Holy Spirit even guide us, may it help us even in this preparation. And even as we start the new week in different places, businesses and careers, Abba Father, we pray that may you go ahead of us. In the mighty name of Jesus Christ, I pray and believe. And may the grace of our Lord Jesus Christ, and the love of God and the fellowship of the Holy Spirit be with us now and forevermore. Amen. Okay, have a good evening ahead.